Hello everyone. So in this video we're going to learn all the basics regarding the foreign exchange and the forex market. So to begin with, what is forex? So every countries generally have their own currencies that they spend within their domestic region. But as and when the situation occurs, like when we go tourism to other countries or intergovernmental transactions like importing materials from other countries or foreign direct investments like say Yamaha, the company from Japan, opened their franchise in India. So for all these type of investments and situations, they will have to exchange currencies which they need with their own currency, right? To exchange the currency, there will be a rate at which one currency can be bought with another currency, and that rate is called the exchange rate. So this exchange rate, according to the market forces, varies frequently. So for the forex trading relies on trading in currencies with the conviction on the exchange rate whether it will rise or fall, right? So as the world is now been connected more economically, forex market is the most liquefied market in the world. More or less forex trading is similar to buying or selling of any other stocks or securities, but the asset here is the currency. That's the only difference. So what is currency? Currency is generally the accepted form of payment to buy anything we need, right? And that currency usually issued by a government or government related authority. Like for India, we have Indian rupees, and for USD, we have United States dollar, right? So the value of all the currencies fluctuates, you know, uh, regarding the supply and demand forces between the currencies. For India and USA, uh, if we demand more US dollars from India, the US dollars value appreciates, and likewise if we demand more Indian rupees, uh, which I mean the US people, when they demand more Indian rupees from the US, the Indian rupees value appreciates. Likewise, the value of the currencies fluctuates with the market forces, and the forex trade actually relies in these fluctuations conviction, right? Whether it will rise or whether it will fall, so that we can opt to trade the currency. So this is how the forex trading core is set it up. So the currency that are in the markets, those are arranged in the ascending order, which is European dollar, which has its most value than any other currency, followed by the Great Britain pound, the England currency, and Australian dollar and New Zealand dollar and United States dollar, and Swiss franc and Japanese yen, right? These are in ascending order. European dollar is the most appreciated currency here. So with this, then currency pairs. So what is a currency pair? Suppose if we opt to trade euro with the USD, now euro will be the base currency and USD will be the core currency, meaning how much of a USD currency is needed to buy 1 euro is the trade setup here. So the second currency, which is here, will be named as the core currency technically, and the first currency euro is the base currency. This means that how much of USD is required to buy how much of euro based on the quantity. So I hope you are clear about the base currency and core currency now. So moving to next, which is types of currencies pairs. See, there are around three types of currencies pairs, which are major currency pairs and cross currency pairs and exotics. So, what is the differentiation here is the major currency pair, all those currencies are traded heavily, right? It has high liquidity, high volume of trades happening in these currencies pairs. So that's why it is known as major currency pairs, which means Euro USD, GBP USD. See, all these currencies, the first one are all base currencies and the second one are all core currencies. And these are major pairs because they have high volume of trade happening every day, right? Cross currency is something which will not have USD in any pairs, right? A pair without a US dollar is called simply the cross currency. See, Euro GBP and Euro franc and Euro JPY. USD will not be there. So the currency pairs which don't have US dollars in it are called simply or the cross currency pairs. And moving to exotics, these are currency pairs which will not be traded much, right? There will be no liquidity in these currency pairs as the trade in these pairs are very low. So the currency pairs which are not traded so much or which are not even in trading, which don't have any high liquidity, or simply known as exotic pairs. And here are the popular crosses, which is without US dollars, which is Great Britain pound and JPY, Japan yen and Euro GBP and CAD JPY. These pairs are major crosses that trades without US dollars in it. So with this, I hope you are clear about all the currency and currency pairs and the basics of Forex market and the core concept of Forex trading. See you in the next video with a new concept. Thank you. Hello everyone. So in this video, we're going to analyze and look all the benefits that are in the Forex trading. So going with the first one, which is low transaction costs. Well, comparing to another markets such as stock or crypto, the transaction charges while buying or selling is levied. Additionally, even well, accepting the transaction charges, additionally even GST is applied in stock market. But here in Forex, there is no such charges or levied. Only brokerage charges taken through spread, and the spread generally varies with market forces. For that, we also have low spread pairs. And moving to the next one, which is no manipulation. Generally, manipulation means taking in a stock market. We say we'll take a particular stock when a group of individuals or institutional investors invest a lump sum money in a stock. That stock will get pumped up like anything. This kind of forced price rise, which is called manipulation, is not at all possible in Forex market. Why? Because there are around 7 trillion trades that are happening per day in USD dollars. So up to that level of money is needed to be invested in a currency in order to manipulate it, right? Which is impossible for any individual or even institutional investors. So that's why there is no manipulation in Forex, and even manipulation is not possible in Forex market. Also, to say further, here in Forex, the asset which we are going to trade is the nation's currency. So manipulating one nation's currency is not at all possible, considering many factors geopolitically. So coming to the next one, which is Forex is also a 24 hours market, which is a benefit as we can trade in any convenient time that we may prefer, be it morning or evening or even night in India, right? So liquidity, there is high liquidity in forex market. As I said, there are 7 trillion trades happening in a day, right? So there is obviously high liquidity. And the leverage, high leverage, the brokers also here in the forex market provide high leverage, obviously. And to explain the leverage, for example, to trade 100,000 units of currency of USD, you don't need to invest full amount, but only around a portion of that, like $3,000. Investing a small amount as margin to uh, trade 100,000 units of currency, a large sum, which is called leverage. So a profit, if you get that, will be a profit of profit for 100,000 units of currency. And also on the other side, if at all it is going to be a loss, that is going to be a loss for 100,000 units of currency. So this is how leverage works. And for that also we need to look in the money management while trading in forex, because of this reason that we will be dealing it with in the upcoming chapters. So with this, I hope you are clear about all those benefits that are in the forex market. See you in the next video with a new concept. Thank you. Hello. In this session, we are going to see how brokerage works and how we should select the broker. Generally, forex market is a decentralized one, which means there is no regulation or control regarding the market of foreign exchange. Also, there is no physical location for the market, it all works through the internet. So, if at all we need to trade in forex, we can do it by various dealers or brokers. For your knowledge, now majorly trades are done through brokers only. So, next, which is liquidity provider. Liquidity provider, what they do is when we trade with currency, these liquidity providers generally assist in all these transactions. Each countries have their own set of liquidity providers. For example, JP Morgan, an American bank, acts as the liquidity provider for America. So let's see how it works. Suppose that this is the centralized bank for the nation, and this nation provides liquidity to the tier 1 liquidity providers, who are like JP Morgan, for say. These are tier 1 liquidity providers, and they transfer the liquidity to tier 2 liquidity providers, who are online brokers or some financial institutions maybe. And from them we make the trade, that means end client. So end client requests trade to the brokers, and they provide liquidity to the end client. How they provide is they got transferred from the tier 1 liquidity providers, who are big banks, big financial institutions, and they got liquidity through the centralized bank. So this is how the forex market liquidity circle revolves and exists. So now moving on to brokers. Well, brokers, what he does is transfers liquidity from tier 1 banks to end client, like we said in the previous slide. And all the clients actually can only trade with the intermediate broker and no other way. That means we cannot trade directly with the exchange, we can only trade with the help of the broker, and there is no other way. So well, it's important to select the broker who has authorization in major foreign forex trading countries. So there is only way you can trade in forex is through brokers, and it's very important to select them wisely, right? So even in trading, there are market makers and retailers. So here broker provides two types of accounts. One is dealing desk and another one is no dealing desk. So you may ask a question, what is dealing desk, why this separation? So let me tell you, one who has more funds such as 50 crores or 100 crores maybe opens account with dealing desk, right? Likewise traders who have 1 crore or 50 lakhs or 10 lakhs opens account in ECN or STP or DMA. So why this separation is to curb the market manipulation, right? Yes, so the big players don't influence the markets, so they get separate account. So by this they're trying to separate and curb the market manipulation and to run it smoothly by the market forces alone. I mean, supply and demand forces. So now coming to the important topic, which is how to select a forex broker. So assume all these points or take all these points as a checklist before you choose a broker. So inquire about all these points before you opt for the broker. So first one is check for the major country's authorization. So if you are going to choose a broker, that broker should have authorization in a major forex trading country, which is important one. And look for leverages, margins and commissions and spreads that the broker provide. So you may consider them who is up for you financially. Yes, and look for also payment mode for deposit and withdrawal. That should be easy is the objective here. So look what they facilitate for payment mode, whether they have a GPay or PhonePay or wire transfer or bank transfer, etc. And opt for what you feel safe and comfortable, right? And also look for how many number of pairs they offer for trading, so that you may look for the pair you want to trade and check for the availability with that brokers that you choose to. So and yeah, this is the most important one, customer service support. See, you can't see them in person and inquire any details, they are in foreign, right? So what is most important is if they are providing a well supported customer service 24 hours, through mailing or telephone conversations maybe, well they should respond you with in 24 hours. So anytime you ask them, they should respond you. That is the most important thing that you should check while choosing the broker. And look for also the experience for the brokers in this forex market field, so that you may trust them accordingly. And so look for all these points before you choose the broker, which are all the most important things to do before choosing the broker. So not only that, if we have more capital, you can also split that capital with two or multiple brokers and trade. See, that's obviously our choice, but that is also a good way in the market to trade. But before you choose any broker, nevertheless, be righteous about all these points that I have mentioned here before choosing the broker. So with this, I'm winding up this video. See you next time with another new concept. Thank you. Hello everyone, in this video we are going to see the active hour timings of forex market. So considering forex market, it's active 24 hours actually, so we can choose to trade in our convenient time, and based on the currency we want to trade, we can choose the time correspondingly. So when it opens at first actually is from Monday morning 2:30 a.m. to Saturday morning 2:30 a.m. We can trade at any time during these hours, but maximum try to avoid doing trade at night after 10 p.m., as traders will be very few at that time and the spread will be very huge for new orders after 10 p.m. So preferably the best time for forex trading is afternoon 2:30 p.m. to night 10:30 p.m. as per the Indian time. So while at these times, as the American and European markets are also will be active. As traders in these markets are enormous, the volume and liquidity will be very high. And that's what this example is also all about. To trade Euro USD pair, trade between 2:30 to 10:30 p.m. as there will be high volume and high liquidity. So moving to next, Forex trading hours session wise as per the Indian time is the Asia session, which is also called Tokyo session, is from 5:30 a.m. Indian Standard Time to 1:30 p.m. Indian Standard Time. And for the North America session, it is from 7 p.m. to 1:30 a.m. the next day as per the Indian timing. And the European session is from 1 p.m. to 10 p.m. as per the Indian timing. So also now the overlapping timings. See, these overlapping zones are actually two are there, which is Asian European overlap, which is between 1:30 p.m. to 2:30 p.m. as per the Indian timing, and US European overlapping, which is from 5:30 p.m. to 8:30 p.m. as per the Indian time. So what's so special about overlapping zones is that these zones are hot zones in forex market, as there will be very high volatility and high volume, and those brings high range fluctuations in pip movements. So if we analyze and trade the movements wisely, we can get a nice sum of profit. Also, if you are to trade in forex, scout the currency movements in the market on Monday and go for the trade during Tuesday or Wednesday and Thursday, as there will be more traders action only on these days. On Monday, we all will be looking for the price movements and analyzing for this week, and the traders action will be on these particular 3 days: Tuesday, Wednesday and Thursday. And regarding Friday, uh, many institutional investors actually closes their orders and may book their profits. So actually try not to take any new orders on Friday after around 6 p.m. maybe. So yes, in this session I hope you're all clear about forex timings and some hot zones regarding the trade, when to take the trade, like this. So see you in next video with a new concept. Thank you. Hello everyone. In this video we're going to learn in detail about spread. So what is spread? See, it is generally the difference between the best bid price and the best ask price. Now the question again may rise, what is bid price and what is ask price? See, to put it simply, bid price is the maximum price that the buyers are willing to pay to buy the currency. Likewise, ask price is the minimum demandable price by the sellers to sell the currency. Right? For example, see, I have taken the Euro GBP pair, and here this price is the bid price, which means the best bid price that the buyers are willing to pay to buy this currency, and this is the ask price, that means the best selling price that the sellers are willing to offer to sell this currency. Right? So here if we go for buy, we will be buying the currency not with this bid price but with this ask price. Okay, and if we sell the currency, we will be selling it for this bid price rate and not the ask price. So this is how the system works. And here the spread is just the difference between these two, best bid price and best ask price, which is 2 pips. And this 2 pips is the spread we'll give as a brokerage fees to the brokers. Right? Moving to the next, which is appropriate pairs to trade. See, so now initially we can start trading with currency pairs which has low spread value, as you will be involved with less risk, because while we execute the trade, the spread that we locked to trade will be taken in the first place as the brokerage, and then if the price moves more in your favor, that's all your profit or losses, right? That's why when we start trade, the spread will be shown with the minus symbol, meaning first the price has to surpass the spread, and that spread is the brokerage charge, and all the remaining movements that are in your favor are your profits. So always go with low spread pairs while trading at the beginner level, as that will be better for beginners, right? Here also, all the investors or traders needs to monitor the broker spread, since regarding your conviction, you need to first earn that spread, and then the price should move more in your favor to get the profit, right? So it is very important to monitor the broker spread for how much it matches your conviction, right? So for example, also if this is the bid price, which is the selling price, and this is the ask price, which is the buying price, that if we buy currency, we will be buying it for this price, and if we sell the currency, we will be selling it for this price, and the spread cost here is the difference between these two, and the spread is actually caused by the exchange rates bid as spread with the broker. So as the exchange rate varies, the spread also varies, and all the spread also varies due to many factors which we will be dealing it later on. So in this video, I hope you are clear about spread and why to select low spread pairs while at the beginning level to trade, and I hope you are clear about bid and ask differences. So let's see in another video with a new concept. Thank you. Hello everyone. In this video, we are going to learn about PIP and all its calculation. First of all, PIP, its abbreviation is price interest point or percentage interest point. So now, what is PIP? PIP means generally the market movement from one level of price point to another level of price point. That in between space between those two price points is calculated as PIP in Forex market. For example, if I take up the trade of Euro USD and I buy Euro at 1.1835 and I close it on 1.1901, then the PIP here is subtracting the closing price with the price that I executed the trade. So which is 66, and this 66 is the pips on this trade I made profit. So traders use this term PIP while telling their profit, such as I made 40 pips profit, I got loss of 20 pips, like that. So the price movements are measured by PIP in Forex, right? So regarding Forex market, currency pairs are priced up to 4 decimal places, and the PIP changes are accounted by the change in the last 4th decimal place. For example, here itself, this is the 4th decimal place here, and the PIP is accounted by subtracting this, and we get 66 as pips, right? Here also in Euro USD, the 4th decimal place is the PIP here. But considering Japanese yen, the Japanese pairs are generally quoted with 2 decimal places, right? So regarding the Japanese pairs, the 2nd decimal place is accountable accountable for PIP calculation. Now if you take the example here, it is 172.119. So here the PIP is 19, and 172.129, here the PIP is 29 pips. So this is how you can calculate the PIP, and I hope you are clear about the PIP. So let's see another video with a new concept. Thank you. Hello everyone. In this video, we are going to learn about swap. So what is swap? Usually the brokers will charge some money for holding the trade after midnight to next day. That charge amount is called swap charge. Well, like interest rates, while we pay them monthly for the loans we avail, same as in Forex, where we trade based on leverages, you know, such as when we set up accounts in MT4 or MT5, we keep some ratio as 1 is to 200 or 1 is to 500, right? Those are all leverages. For example, if I have $100 in my account and my leverage is 1 is to 100, I can trade up to the value of $10,000, right? The balance will be provided by the brokers. This is called leverage. So, with this, when you are holding this leverage amount trade to next day, you will be charged with swap fees, right? Also, swaps changes with lot sizes, right? Such like for micro lot, swap charge is different. For standard lot, swap charge is different and also high. So now, when they will exactly charge swap is, you can buy currencies at any time during morning or evening, but you will have to close it before 11 p.m. at that night. If not, then swap fees will be charged by the brokers. That will be calculated timely. Different brokers charge different timely swap charges after when we hold the trade to next day. Some brokers charge after 12 p.m., some even calculate from 11 p.m. So if we close it before 11 p.m., there will be no swap charges at all, right? Suppose if we hold after 11 to next day morning, a small amount will be taken as swap fees. So moving to next, there are two types of swaps here. One is swap long, that is keeping when you keep long positions, when you take a buy order and keep that position overnight, the swap long will be charged, and swap short, like when you keep a short position overnight, swap short will be charged. Swap charges varies with brokers. For example, here I have mentioned, I have taken one example, Euro USD. Swap charges for a particular broker is, when you take a swap short, it is 0.01, and when you take a swap long, it is 0.48 cent, right? It varies with brokers, these charges. So next, which is where to search this swap charges detail for the trade is, when you are using it in PC, MetaTrader 4 or MetaTrader 5, you can click view and then market watch and go for symbols, where you can select the currency pair on which you want to see the swap charges, and then select the properties if it is an MT4 web app, or select specification if it is MT5, right? And then you can see the swap charges around here for the currencies. These are all if you are using PC, and when you are using mobile, in whether it is MetaTrader 4 or MetaTrader 5, click on quotes and then select the currency pair on which you want to see the swap charges, and then select symbol properties, whether it is on MT4 or MT5, right? And then you can see the swap type. For swap long, you can see the charges, and swap short, you can see the charges for any trade that you want to see the swap charges for, right? With this, I hope you are clear about swap and swap charges and when it will be charged. Well, see you in the next video with a new concept. Thank you. Hello. In this session, we are going to discuss about marginal trading and lot sizes. So now, marginal trading generally means that we can trade with small amount of capital and access the large capital, right? Here we can assume that the risk and reward are proportionate to each other, which means, well, we can gain huge profits and also we may end up in huge loss. So we can trade with minimal amount as margin and trade a highly quantified and value lot. For example, if you have 1,000 US dollars, we can trade a lot which are of value 100,000 US dollars. So this is what we say as 1 is to 100 leverage trading. Likewise, if we keep ratio of 1 is to 500 also, and if we have $1,000 in hand, put it up, we can trade a lot of value around $500,000. So what I mean by here is, well, leverage is investing the small amount to access the large capital, and that small amount that you invested is known as the margin. So this type of trading is marginal trading, and the entire concept of having invested small amount and accessing the large capital for profit or loss maybe is called marginal trading and leverage. So I hope you're clear about marginal trading and leverage now. So moving to lot. So there are three types of lots in forex market. Lot is specifically to mention is just the quantity of currency in forex that you are going to trade, that you are willing to trade, right? So there are three types of lot that the market specifies. Is one is standard lot, which has 100,000 units of currency, and another one is mini lot, which has 10,000 units of currency, and the last one, not the last one, maybe micro, which has 1,000 units of currency, and last one nano, which is 100 units of currency, which is not traded in market as of now, but some brokers may provide, but not majorly. Nano trading is not happening as of now. So as lot size, you can see, as lot size increases, the quantity of currency units also increases. So the minimal lot in forex is the micro, which has 1,000 units of currency, and the maximum is standard, which has 100,000 units of currency. So lot size, it is actually lot size, or as we say see earlier, standard, mini and micro. The standard lot is 100,000 units of currency, and mini lot is 1/10 of the standard lot. So divided by 10 provides 10,000 units of currency, and the micro lot is 1/10 of mini. So divided by 10 provides 1,000 units of currency. So this is what we wrote here as the to mention as a lot. We mentioned the standard lot, which are of 100,000 units of currency, as 1, and mini as 0.1, and micro as 0.01. So now, well, if you trade with standard lot and the trade is in your favor, the profit is huge. And if the market does not favor your condition, and if you trade a standard lot, you may end up in huge loss. But considering many lot, the effect of profit or loss regarding your conviction on the market is less effective considering the standard. So that's what we mentioned here. The size of a mini lot means that the profit and loss is profit or loss effect of that loss while trading in mini lot is less than standard lot, be it profit or be it a loss. Likewise, also while trading a micro lot, the effect of profit or loss is less than the mini lot, and same applies for nano considering micro. So this is how the lot size has been set it up. So I hope you are now clear about the lot sizes and lots and leverage and marginal trading and all. So I hope you are clear on all this and hope to see you in another video with a new concept. Thank you. Hello. In this video, we're going to see about types of traders. Types of traders generally refers to people who trade with their own set of ideology and their own patience level, right? So going with first one, which is swing traders. These traders generally will have a trade setup of achieving the target within few days or weeks. They open the trade and execute it with a target achieving in a few days and close the trade at all of a sudden. These type of traders who hold the trade for days and weeks are swing traders. Next one, which is positional traders. These traders trade till the underlying attains certain position, right, from one point to another. For example, if I buy say stock for rupees 100 and hold it in the idea of selling it when it reaches 150, regardless of time, be it days, months, or even years, my decision is to hold it till it reaches the target, no matter the time it takes. This type of traders is called positional traders. Moving to the next, which is intraday. These traders who open their position and close within the day, that is before the end of that trading day, are referred to intraday traders. In this type of trade in forex market, we also don't owe any swap charges as it is intraday. I open a trade in a day in the morning and I close it within the evening. Right? This type of trade opening and closing at the same day is referred to as intraday trading. Right? Moving to the next and final one, which is scalpers. These traders are aggressive traders who take up trade and close within hours, a trade of 1 hour, and even opening and closing the trades within minutes, achieving the targets up to certain level, are referred to as scalpers, doing the trade between hours, opening and closing between hours and minutes, and achieving a small targets according to them, and being very aggressive on taking up the trade. They are referred to as scalpers. So these are the types of traders, and we can opt to be any type of trader based on our ideology and patience level. Thank you. Hello everyone. So in this video, we are going to see about order and order types. So order, what is order? Every trade in forex is generally done through only brokers, right? So here the transaction that we take up to buy or sell the currency is called the order. For example, if I decide to buy euro USD pair, I'll instruct the broker to buy that pair. That instruction to the broker to buy or sell the currency is called the order, right? Now coming to order types, first one is market order. See, market order is simply buying or selling of currencies at that present current market price is the market order, right? We cannot set any specific price. We just going to buy or sell the currency at that moment prevailing market price is called the market order. Example, if for currency is trading at rupees 100, if I choose to buy that currency for 100 rupees, that's the market's price, so that order is called market order, right? And moving to next, which is pending order. subsection of pending order, which is a limit order. Limit order is this is the order where we can set the price limit. In case of buy, we can set the price at that price or below that price. The buy order gets executed, right? We set the price where the buy order at that price or below that price the buy order will get executed, and not when the market price is above that specified price, right? Likewise, in case of sell, we can set the price where at that price or above that price the sell order gets executed, and not when the market price is below the specified price. See, these buy or buy limit sell or sell limit order, buy limit order or sell limit order can be used when in certain areas where when the price breaks the support level, and if you think it will retrace and go high, we can use the buy limit where the price hits the low below the support region, right? And we can use the sell order if you think when the price breaks the support level and it will retrace and further go down. You can use the sell order at the price where the price hits the high at the retracement, right? Likewise, buy order and sell orders can be used. So moving to the next one, which is stop order. Stop order is like when to stop the order in case when the market goes against our favor, right? Stop order is generally the stop loss order, where it can be used to manage our risk, right? Here also the buy stop order is, let me explain you with an example. If the market is trading at 200 rupees, say it has lifted from the support region and now it is trading in the 200. And hello everyone, in this video we are going to discuss about money management. Money management is a very important one that should be considered with high priority. So regarding money management, it's not how much you make profit, but it's how well you protect your capital. So minimizing the risk potential when we take up the trade is the crux of money management. So how do we minimize our loss potential? At first, when we take up a trade, we need to calculate how much money we are going to risk for that trade, right? Then, for example, if I have capital of 10,000 US dollars, you can trade with a risk of 2 to 5 percentage per trade. That is, for 10,000 US dollars capital, risk per trade you can take is minimum $200 to maximum $500, right? Here what I mean by risk is the space between the entry and stop loss, that can be minimum 2 to 5 percentage from the capital. So you might ask, what's the benefit of risking only 2 percentage capital? So the benefit is, suppose if you take that example itself where I have 10,000 US dollars capital, with risking only 2 percentage per trade, I can take around 50 trades, right? So initially, if you even lose money, you can eventually be profitable by taking the upcoming trades, multiple trades. So what's so important is you will have enough money in your capital to take multiple trades, right? Likewise, here when you risk certain percentage, you should also look for how much reward is worth for that risk. Then compulsorily use stop loss while trading, and use take profit order to plan trade exit, right? And this is important, where you should always trade with the risk amount that you are affordable to lose, and not more than that. And another factor about risk management is also maintaining risk level is important. Suppose if we take profits in around 4 to 5 trades, we should not increase our risk capital from 2 to 5 percentage to 7 percentage, 8 percentage, or 10 percentage, like that. We should always trade with the fixed risk percentage, you know. Then also setting up the risk reward ratio. You can set up like 2 is to 1 or 3 is to 1. For example, if the ratio you set up is 2 is to 1, if the risk is 2 percentage, the profit should be 4 percentage. And if the ratio you set up is 3 is to 1, and if you take 2 percentage risk, the profit should be 6 percentage. So that's how you fix your target also. So here you can also see the difference between the good account and a bad account. You know, both have the same capital, which is $10,000, and this account have risked only 2 percentage, and here they have risked 20 percentage. But both have set the risk reward ratio as 3 is to 1. So if you see here, they have actually had a loss of around 6 trades, and they profited from only 4 trades, right? Still they are in a profit position, but here with 20 percentage risk, they have lost 5 trades and they have won 5 trades, but still they are in negative position. This is the thing that you should realize about risk management, right? So don't risk too much money in your capital for trade. Always risk minimum amount of capital, which is minimum 2 percentage to maximum 5 percentage, right? So moving to the next, which is how to manage risks in forex trading. The other factors that we need to look for. First of all, before entering the trading, understand the forex market. Understand how the market runs. You should be well versed with the core ideology of forex market and how it runs and how it works, like that. Get a grasp on leverage. So leverage, inevitably you are going to trade with leverage. So get a clean grip of knowledge about the upsides and downsides of leverage concept. Then trading plan. Always predetermine where to enter and when to exit and where to put stop loss, and then enter the trade, right? This is how a well planned trade setup should be. So, and then moving to risk reward ratio. You know, always take the trade when you are getting profit worth your risk. Otherwise, it's not a quality trade. Keep 2 is to 1 or 3 is to 1 ratio, which is sufficient risk reward ratio. So the next one is use stops and limits. You should must fix the stop loss and then only trade. Without stop loss, you should never trade, as that can pull you into the danger you can never imagine. So always use stop loss and then trade, right? And then manage your emotions. You know, set up a trade plan and enter the trade. If it favors, you get profit. If it not, then you will lose the stop loss that you determined before. Keep this ideology as simple as that. Don't get into emotions like doing counter trading for covering your previous losses, or becoming over greedy and taking up trades without proper structural setup. Don't go for such situations. Always make a plan on your trade setup and then enter the trade. You will be consistent in trading. While you are consistent in trading, you will eventually make profits, right? And keep an eye on news and events. Generally read news where it relates to any particular currency. You know also you need not to be very good with international affairs completely to trade, as trading in itself 80 percentage comprises of technicalities. Knowing it is more than enough, but certain news assist you in your decision for trade, right? And it will have its effect for certain period of time. So having a bird's eye view on news would assist you to make comfortable decisions regarding trade, right? And then the last one is start with a demo account. Don't just jump into real market at all of a sudden, right? Use demo account as it will be similar to real account, and become well versed with the user interface things, like of how to use orders and stop loss, all that. And look if all your setup goes well for 5 to 10 times, and then steadily enter into the real market, right? So with this, I hope you get certain idea about the money management. Well, see you in the next video with a new concept. Thank you. We're going to see about trend line concept. So here we will see how we can construct the trend line, and how can we trade using the trend line. So at first, I have drawn the market price movements here based on the highs and lows the prices moved previously, like you know from this high to this low, and then high, and then again to a low, and then a high, and then to a low. So like this, I have drawn the price movements here. So now let's see how to plot a trend line. So to plot a trend line here, if we can connect two lows, and we proceed to extend it further up to a certain level, like this. So this line acts as the trend line connecting higher lows. So as it is connecting higher lows, and this trend line acts as the trend line for uptrend, right? As it is connecting higher lows like this. So now having connected the two lows here, the price when it touches the line for the third time, that is around here, this time we can take the buy entry, as because from here there is a 70 percentage probability that the market will rise to a new high than the previous high, right? So likewise when it touches for the fourth time, that is around here, here also we can take the buy entry, as here also we have 50 percentage probability that the market will rise to a new high than the previous high. So these are all the buy entries having much probability. So now when it touches for the fifth time, here the trend will most probably break out. At some time, at some rare cases, it may rise to up to a certain high or equal high with the previous high. We can say there are only 20 percentage chances when it touches for the fifth time for the market to rise. So most probably the trend will break out. So here after the sixth time, you can clearly see the trend here breaks out, this here. So here now the trend line has been broken. We should not go for buying after this has happened, as trend line breaking up. So this is the trend line for uptrend, and this is how we should construct and use the trend line for the uptrend. So now, considering the downtrend, as like we did in the uptrend, now also we are going to connect uh, two lower highs here, right? And we proceed to extend it to further like this. So this line connecting all the lower highs acts as the trend line for the downtrend. So here also, after connecting the two lower highs, when it touches for the third time, that around here, there are 70 percentage probability that the market will go down, giving a new lower low than the previous low. And when it touches for the fourth time, we'll have a 50 percentage probability that it will give a new lower low than the previous low. And then after the fourth time, the market will most likely break the trend line, and it will move to a certain high than the previous high, breaking the trend line after the fifth time. So this is how we construct the trend line for downtrend, and how we can use the downtrend to trade is when it touches for the third time, we should go for shorting. You know, uh, from the third time, there will be a 70 percentage probability for the market to go down further than the previous down, giving a new lower low. And from fourth time, there are 50 percentage probability giving a new lower low than the previous low. So around here, we can use the downtrend trend line for making the sell entry. So with this, I hope you are clear about trend line concept, and how to construct it and how to make use of it to go for trading. So next time, I'll see you with a new concept. Thank you. Hello everyone. So in this video, we're going to learn about how to identify the trend. So here I have drawn the price movements with highs and lows like this, based on the price movements that's here, like this, from this high to this low, and from this low to this high, and then from this high to this low, and then a high, and then low. So like this, I have drawn the price movements here with highs and lows, right? So now, let's assume that the price from this low goes to a certain high, and then the price retraces back to a certain low, and then goes to a new high. So here, uh, the price has broken the previous high, that is around here, right? From this low, the price has broken the previous high, and it created a new higher high. So this is considered as uptrend. So likewise, it again moved further down to a low, where this region acts as the support, and then the price from this low breaks this high and creates a new higher high than the previous high. So this is considered as an uptrend, breaking the higher highs. So also here you can see, as there's a resistance zone here, the price moves certain points down and it gets support of around here, and from this low the price moves to a new high, breaking the previous high, and this breaking higher highs and creating a new highs is considered as uptrend market, right? So to identify the trend, we need to see if it breaks the previous high and creates a new high, right? So here we can see the price hits the resistance level, and it goes down to a support level, and it retraces back, and here it does not break the previous high, right? It again moved down, creating an equal high. So this range, creating equal highs and equal lows like this range is considered as sideways market, not breaking any higher highs, or not even going to lower lows like this. Create fluctuating within the bounded range is considered as sideways market. So here you can see equal highs, not breaking anything. So this is sideways market, and this is breaking the higher highs is considered as uptrend market. Here also you can notice that the lows are creating a higher lows. This low is a higher low than this low, and from this low it created a new higher high, breaking the previous high, and it retraced from the resistance zone, and it got support around here at the previous high zone. So here this is considered as low, and this low is the higher low than the previous low. So price movements breaking the previous highs and creating a new highs, and breaking the previous lows and creating the new lows, new higher highs and new higher lows, are considered as uptrend market. And in sideways market, the price movements will not break any previous highs or lows. It fluctuates between the range, right? Here you can see there is equal highs here. The price movements trading between the equal highs and equal lows are considered sideways market, right? So with this, now we will move on to the downside market, downtrend. Here you can notice that from this high the price has moved down, breaking the support area, and it has broken the previous low here, right? Hello everyone. In this video we are going to discuss about support and resistance. Generally in market, whenever people starts buying something, the demand for that increases, and as the demand increases the price of that will also increase, right? And in the long run, as the price now has been increased, people who bought earlier tends to sell for the profit, right? And as they keep on selling their accumulated sources, price tends to get lower, as there will be more supply in the market as everyone sells now. And after this, again demand will rise when supply is not there, and people start to buy, and the cycle continues like this. Now here the support area is where the people buy as there will be demand, and the resistance area is where people sell as there will be supply in there, right? Having said this, now here I have drawn the price movements based on the previous datas, like, you know, high to low, and then high, and then again low, and then high, like this. So based on this I have drawn it here. So let's assume that the underlying is trading at rupees 100 in the support region. Support region is where the buying pressure prevails, right? So people starts to buy, and because of that, by the demand for that underlying will increase, and the price will reach up to 200. Let's say the price is reached to 200 now. So people who bought earlier around here at rupees 100 tends to sell it here, as they will get profit, or they will get double the profit of their investment. So here, when they start to sell, they pull in the supply in the market. So as the more supply comes in, the price of that underlying will gradually come down up to here, around here, right? So let's say here the price will be around 130, right? So here what we should understand is, here is the support region where people started to buy, and it has reached 200, and here they started to sell for the profit. So the price which has reached up to this level 200 acts as the resistance for the underlying. So here is the support for that underlying, and here is the resistance for that underlying. Now after this, when the price gradually comes down at rupees 130 around here, the people who bought at rupees 100 will eventually start to buy at rupees 130, right? And as the people start to buy, the price will gradually increase, breaking the previous resistance area, giving a new high level, which is rupees 300, right? So now what will happen is, this 300 price will act as the resistance, and this 200 price will act as the support from here on, right? As this is the new resistance, the people who bought at 130, as the buying pressure was there here, the price has been increased to 300, and from 300 the people who bought earlier at 130 tends to sell, and as the supply comes in, the price will gradually gets down to rupees 200 again. There is a support level at 200 previously, which has been the resistance, now will act as a support, and people starts to buy from here on, right? And they will break the previous high price, previous resistance, which is 300. The people who bought at 200 will break this price, and the price will go on up to 400. So from now on, the price at 400 will act as the resistance, and price at 300 will act as the support. So as and when the price fluctuates between these two, price at 400 creates the selling pressure, and price at 300 will create the buying pressure. So at 400, the people who bought it around 200 to 300 will start to sell here, and as the supply comes in, the price will gradually lowers to 300, and as the supply is over, the demand will eventually start to increase from here. So at 300, the people starts to buy, breaking up the previous high to a new high, breaking up the resistance here at 400 to 500, right? So now from here on, like this 500 acts as the resistance, and 400 will act as the support. So likewise, support is the region where people buy, and resistance is the region where people sell. So this is the uptrend market where the price has been increased duly from rupees 100 to 500. And now let's see when the market goes down. So here at the 500, people will start selling, breaking the support level, which is at 400. So even at 400, people didn't buy further, uh, that may be due to many market conditions, breaking the support level and reaching the price to 300, which is lower than the previous support. So now at 300 there is a support level, so people tend to buy it in here, and the price gradually rise due to the buying action, the price reaches 400. At 400 where the resistance now acts, right? At 500 this is the resistance, this is the support, right? At 500 the price breaks the support and reaches till 300. So now 300 will act as the support and 400 will act as the resistance. So at 300 support, people started to buy and the price gradually increased to resistance level, which is 400. And after that also, as the market is a downtrend market, from 400 people started to sell, breaking even the support level here, which is at 300. You know, they broke the support level and the selling action reached up to 300 rupees, where at 300 rupees now will act as the support region and sorry, at price reached up to 200 rupees here from 400, breaking the support which is rupees 300, where now the at 200 price region will act as the support and 300 will act as the resistance area. So likewise, uh, the price from the resistance area starts to sell and keeping it lower than the breaking the support and keeping it lower than the support. Now the support will be shifted towards here and the rupees 200 will act as the resistance. So likewise the support and resistance works in. So I hope you are clear about how the support and resistance works and how it can be constructed regarding the price movements. Let's see another video how to apply supply and support and resistance practically and take up the trade. Thank you. Hello everyone. So in this video we are going to see how to construct the support and resistance in the live chart. Right? I have taken Euro USD chart for the construction of support and resistance. So to do so, just first of all convert this candle chart into line chart for ease of our work. So now what we are going to do is we'll just take up the previous data to construct the support and resistance levels. So now what we are going to do is just we'll just take up the horizontal line in here. I'll select this, and what we are going to do is we will connect the two lows here, right? There is a two lows. We'll try to connect it with this. Yes. So after this, here is two highs. We can connect this, and here we can connect it here around. We have connected two lows, you know, this region and this region has been connected and extended, and here also this region and this region has been connected. So likewise here we can connect this also. This is a low, and we'll connect this high also, right? So what we have done here is have connected this point with this point, and we have connected this high. So after connecting all the lows and highs to the maximum, just convert the line chart again to candlesticks. So now just connect all the candles that you have connected with this rectangular bar, and again this thing here. and around here, and also here also we have a support line, so we will connect it here also. So now this acts as the resistance zone where the price hits the resistance level and comes down, and this region acts as the support zone where the price was restricted to fall further and price rising up to a certain level here. Here also, after the resistance level the price is touched, it has fall down, breaking the support level, creating a new support. Now here, this line, this region acts as a support, and this region will act as the resistance now. So after it has retraced again, breaking the resistance level, and it is hit the previous resistance level and it started to fall again, right, breaking the support level around here, and it has reached this support level, and it even break this support level, creating a new support level. So now regarding this region will act as the resistance zone, and this region will act as the support zone, right. This is how we can construct support and resistance. So we'll do this again with another currency pair, which is JGBP USD. Yes. So with GBP USD, we'll just convert this candle into line chart, and we will connect with all the previous datas. This region we can connect the highs, and this region will act as a high level, and this region connecting the lows, and in around here connecting the lows, and here also there is a high which has been given here. Yes, so convert this line chart into candles again. Now just connect all the lines which connects the low. These are all highs that has been connected. So again around here, so we'll connect this lows up to the end, and we will connect this low yes, and here it is one zone we can connect. So yes, so here this acts as the resistance zone where the price from here falls down and reaches the resistance level again for after the retracement. After touching the resistance level here, it further falls and stays here, and also price falls further down, and here is a support region where the price again lifts up, hitting the resistance region, and again hits the support and again hits the resistance. Likewise it goes, and here you can see the price breaks the support level, creating a new support level. So this region will now act as the resistance zone for this area, and this region will act as a support zone. So from support zone the price is raised further, breaking the resistance level here, and it is given a new high. So we can keep even this also as a resistance level, right, also as a resistance level. And at resistance level the price hits, and further it breaks the support level, and also to the next support also it breaks, right, creating a new support level which is here. So for this region, this support level will now act as resistance region, and this region will act as a support. So the price further moves, breaking the resistance, hitting the another resistance level, and price falls to the support level and then rises and then hits the resistance level and then falls. Here it breaks the support level. So from here on, this region will act as the resistance and this region will act as the support level. So recently it has broken this, even this support level, and it has retraced back to this level. So the price when it breaks here, this region is a support region and it fell down further the price, and it has retraced back up to this. So for now this region will act as the resistance region for this price. So this is how you can construct the support and region level, and I hope you are clear about how to analyze support and regions level, support and resistance level, and how to construct the support and resistance level. Let's see in another video with a new concept. Thank you. Hello everyone. So in this video, we're going to learn about channel concept. So like a trend line channel is also more or less the same, but with little differences. So we'll first connect the trend line here. For that, we'll have to connect the first 2 points and then extend further beyond till the trend continues. So we'll have it in green color as it is uptrend. So now for a channel, not only higher lows, but you'll have to connect also the higher highs like this. So this acts as the channel for the uptrend as it connects all the higher highs and higher lows. So how you can pick the trade here is, like I said, like in trend line, when it touches the line for the third time, there is 70% probability for the market to rise up to a certain high which is higher than the previous high. So we can enter buy here, and also this concept is like trend line, but regarding channel also, from here, from here there is 70% chances that it will go down, creating a higher low than the previous low. This is what channel is all about, right? So also when it touches the fourth time, there is a 50% probability that it will rise to a newer high, and from here, as it is a channel, there is also a 50% probability that it will come down, creating a higher low than the previous low. So we can trade within the channel like this. So as it is the fifth time, the market will more likely break out of the channel, is the prediction. So also at some rare cases there is 20% chances that the market may rise, and it will eventually break out during the sixth touch, that you can see here. When it touches the line for the sixth time, it eventually breaks out, right? At fifth time itself, it will most probably break out. At some rare cases there are 20% chances that the market may act within the channel. At sixth time it will break out the channel mostly, right? This is all about the uptrend channel and how you can make use of the channel to take the trade. Now considering the downtrend, as like we did in the uptrend channel, here also you just connect all the lower highs like this. So we'll have it in red, and also for a channel you should also connect the lower lows like this. So this acts as a channel for the downtrend. So like I said in the uptrend, at the third touch in that line, there is a 70 percentage more probability that it will go down, creating a lower low than the previous low. So you can take a sell entry here, and at the fourth touch there is 50 percentage probability that it will further go down, create a new lower low than the previous lower low. So with the downtrend channel you can take the trade using within this bounded range. Likewise, also from here there is 70% probability that it will come down. From here there is 70% probability that it will further rise, creating a lower high than the previous high. Also from here there will be as it is a fifth touch, the channel will most likely break out, like the channel will most likely break out like this. It can go breaking up the channel from here. So on a downtrend channel we can construct the channel with by the strategy that I have mentioned here, and we can trade using the downtrend channel during the third and fourth touches, as there are more probability that it will create a lower lows. So with this I hope you're clear about the concept of constructing a channel and how to take up the trade within the channel. So see you next time with a new concept. Thank you. In this video we're going to see how to construct channel and how to make use of it to take the trade. Right, I've taken GBP USD pair to construct the channel. So first of all, to construct it, like we do in trend line, we'll just select the trend line tool and we'll just connect the two higher lows like this, right? And what we'll do is we'll just proceed this line like this, right? Yes. So this is what we do for a trend line. Considering channel, we should also connect the higher highs like this, and we'll also extend this line up to a certain level like this. Now let's see what happens here. See, we can see when we connect with two higher lows and two higher highs for a channel, the price movements are within the boundaries of that channel. So how we can infer this channel to take the trade is, we'll just proceed further, right? So here when it touches for the first time and it goes to the low and it again retraces and it touches here and again, and it goes low again and it touches around here for the third time. When it is the third time, there are 70% probability that it will further go down, creating a higher low than the previous low here, right? So we can take the sell entry here for a trade, and from here also we can take the buy entry, as there are 70% probability that it will rise to a new higher high than the previous high. So this is what we should do when the price movement touches for the third time, and here after this when the price movement touches for the fourth time, there are 50 percentage probability that the price will go down, touching a new higher low than the previous low, and from there is a 50 percentage probability that it will further rise to a new higher high than the previous high. So these are the points that we should note while trading with the channel. And after the fifth time, when it touches for the fifth time, there most probably the channel will break out, as there are only 20 percentage chances that the price movements will be within the channel. So most probably uh, the channel will break out. So here you can see when it touches for the fifth time, that is 1, 2, 3, 4, and 5. When it touches for the fifth time, you can see that the channel is breaking out here. So this is how we can construct the up channel for the uptrend and make use of it to take the trade. So let's see now with the downtrend. So we'll proceed this chart further. You can see the channel has been broken out for the uptrend channel. So let's see now for the downtrend how to construct the channel. So for the downtrend, like we did if during the uptrend, just will connect two lower highs like this, and for a channel we should also connect two lower lows like this. So what we will do is we'll just connect the two lower highs and lower lows, and we'll just look what happens next. So here we'll just extend this line further, and also this, to consider this as a channel. So now if we proceed to watch what is happening, see, we can clearly see this is a downtrend channel and the price movements are within the channel. When we connect the two lower highs with the and the two lower lows, and the price movement trades within the channel, right? So in case if it bigs like this, the upper shadows here, we can still extend some of the portions for the channel, like connect with another line like this. So consider this all portion as one area for the channel, as a upper boundary for the channel, right? So here also if we see 1, 2, 3 during the third touch, we can take the sell entry as there is 70 percentage probability that the price will go down to a new lower low than the previous low, and from here also that is 70 percentage probability that it will rise up to a certain level which creates new lower high than the previous high, right? This is the third time, and when it is fourth time when it touches, there's a 50 percentage probability that the market will go down to a new lower low than the previous low. And here when the market touches for the fifth time, you can clearly see that the channel breaks out here, as there is only 20 percentage probability for the price movements to trade within the channel, right? So this is how we can construct the channel and make use of it to go for trading, right? Let's see another video with a new concept. Thank you. Hello everyone. In this video, we're going to discuss about some of the important candlestick patterns, right? So to begin with, first of all, shooting star. Yes, shooting star. Well, defining about the structure first, it will have a long upper shadow like this. This wick, long wick, where the this wick's length uh, is at least twice the length of the real body. This is the real body, and this wick's length is at least twice the length of this real body. When this structure forms, it is known as shooting star. Well, here the color doesn't matter. However, it's more reliable when it's in red. And the longer the upper shadow here, the longer the wick, the more bearish the pattern will be, right? So, shooting star in the uptrend will indicate the trend reversal, that is downtrend. As you can see here itself, when the shooting star forms, and after this the market goes down to a certain low, right, like this. So moving to next, which is tweezer top. Tweezer top is when two candles like this occur back to back with similar highs, right? As you can see here, the similar highs and this similar highs and similar highs, right? That these are known as tweezer tops. This indicates bearish reversals when it appears in the uptrend. As you can see here itself, uh, well, this is a bullish candle, and this is the bearish candle as it is green and red, and with similar highs. So it also appeared in uptrend, indicating that after this candle, red candle has formed with similar high. We can probably predict that the this is a tweezer top, indicating the trend reversal. That is, price will go down to a certain level. Also, here you can see the bullish candle after bearish candle and with similar high, and then the price goes to to certain low, right? So this is how we can analyze the tweezer top pattern. And tweezer bottom, like we said in tweezer bottom, here these are the two candlestick patterns occurring back to back with two similar lows here, right? This indicates bullish reversal when this tweezer bottom appears in the downtrend. As you can see here, first the red candle, bearish candle, followed by bullish candle, and with similar lows here, right? It also appeared in downtrend. So with this, the trend has reversed from here. As you can see, the market goes up from here, right? Uh, bearish candle followed by a bullish candle with similar lows. A downtrend indicates that this is the tweezer bottom pattern formed, and this pattern will indicate a trend reversal from downside to upside. And this one, tweezer top, a bullish candle followed by a bearish candle with similar highs, and at the uptrend, these pattern is formed, and then this will indicate that the price will go down, as you can see here, right? These are tweezer top and tweezer bottoms. And the next one, which is bearish engulfing. See, bearish engulfing, these are about two candles, right, occurring back to back, with which the candle which appears later, that is the second candle, can engulf the former candle, first candle, right? And it is said to be bearish engulfing when the first candle is bullish, right, and the next is bearish, and in which the bearish candle can engulf the bullish candle by its size. As you can see here, this size of the candle can be engulfed by this size of the candle, and this is bullish and this is bearish. Bearish engulfs the bullish candle here. So this pattern is known as bearish engulfing. After this, by this bearish engulfing pattern, we can predict the market will go down, right? After this, as you can see in itself here, the bullish candle is engulfed by the bearish candle, and the market, and the bearish candle has been appeared, we can confirm the pattern, and the market gone down from here, right? This is bearish engulfing pattern. And coming to bullish engulfing pattern, like we said in the bearish engulfing, these are two candles with which the first is engulfed by the second candle. And well, it is said to be bullish when the first candle is bearish candle, and that bearish candle is can be engulfed by the second candle which is bullish, right? As you can see in itself here, this red candle can be engulfed by the this green candle by its size. So this is said to be bullish engulfing pattern. And as it formed in the downtrend here, as you can see, after this formation the price goes to a certain high, right? This is bullish engulfing pattern. So with this, I hope you are clear about some of the important candlestick patterns, and these are all the trend reversal patterns most importantly. And I hope you are clear about all this. Let's see in another video with a new concept. Thank you. Hello everyone. In this video, we're going to identify the candlesticks patterns in the live chart, and we're going to see the effect after the candle has been formed. So right, to begin with, we can start with the bullish engulfing pattern that is formed around here. See the bullish and engulfing pattern where the bullish pattern engulfs the bearish pattern by its size. So here these two pattern, right? So after the bullish pattern has been formed in the downtrend, actually see the movements upwards. So the trend, as you can see, from this high to this low, after the bullish pattern formed here, it goes breaking the previous high itself. So that's how the bullish pattern and bullish engulfing pattern works. So moving to next, which is, let's look for bearish engulfing pattern around. This is in the live chart we can see, yes, here you can see the bearish engulfing pattern, these two candles, right? These two candles where the bullish candle is engulfed by the bearish candle by its size. And after this pattern has been formed, see the price movements. You can see from, as before the pattern has been formed, the price movements was from this low to this high, and after the pattern the price movement gone to a far down, breaking even the previous low. So this is how the bearish engulfing pattern works. And moving to next, which we can see for the next pattern, which is around here. Here we have tweezer bottoms, right? Yes. So for tweezer bottom, see the bottoms are at the same level around here. These two candles, where the bearish candle and the bullish candle have the same lows, and also here we have the bearish candle and bullish candle having the same lows, right? Here and here, right? With which you can see after the tweezer bottom has appeared, you can see the price movements. So previously it has gone from this high to this low, and after the formation the price movements gone further up, right? After this formation the price movements has gone further up. This is how the tweezer bottom works. Also here, after the tweezer bottom has formed, you can see the price movements here going to a certain high, right? This is how the tweezer bottom works. So let's look for the another pattern. So here we look for the next pattern, which is available around here. You can see the shooting star pattern here, right? This particular red candle, this particular candle, red candle, with the upper shadow twice the size of the range of the body. So this is a shooting star, and when this appears in the uptrend, actually you can see the price movements going further down. So this is an bearish reversal pattern. You can see, as from here the price moves up to this, and after the shooting star has formed, you can see the price coming down further. So this is how the shooting star in the uptrend works. So every pattern we saw works as a trend reversal patterns. So with this I can, because I hope that you are clear about all the trend reversal patterns that I have taught you. So let's see another video with a new concept. Thank you. Hello everyone. In this video we're going to discuss about a strategy that works quite well in giving out good quality trade signals, right? To begin with, we're going to add two moving averages here, right? Moving average and exponential moving average also, right? So we're going to change its value to our convenience. I'm going to give around 169 for simple moving average. I'll also change this color, right? And for exponential moving average, I'm gonna give input as 89, right? And the color could be blue itself. Fine. So here we had a crossover, right? Moving average crossover has happened. So to find this crossover only, we are adding a moving averages indicator. So after finding this crossover, you need to analyze the trend. So for that, analyze the trend, just connect with the high to lows like this. And after this, it is gone. So here you can clearly see the previous high here has been broken up here. The price movements here broken the previous high. So the trend, we can predict this as an uptrend, right? So we added the indicator and we got the crossover and we analyzed the trend also. So in the uptrend, we always go for buy, right? Now where to take the buy entry? This is the question that arrives next. So where to take the buy entry? Look for the candle confirmation here. Here here itself I have the paper umbrella candle confirmations. So for me, I would enter the trade here. I would put my buy entry here. here, right? And I would keep my target as for that I will look for the high, previous highs, that's around here. So this is the resistance level we have by the previous data. So we'll just have this data, right? So I will keep this as the target level. So here I would take the entry. Here I would take the entry and I would keep this level up to this level as the target level. Considering the stop loss, I would keep this previous low as the stop loss, right? Here, previous low as the stop loss. In case if we miss this divergence point in itself, we should look for the retracement here, where it retraces. See, the price movement has gone further up and it retraced here, right? It gone to a certain turn and it retraced here. So here also you can see the paper umbrella candle confirmation. So when you miss the first opportunity, you can take the entry trade for buy during the retracement, as it will be the second entry. So here you can enter and keep the profit, keep the target up to the previous resistance, up to this resistance level. You can keep this as target, and the stop loss you can have it as the previous low, which is around here. For this entry, enter the trade here, keep the previous low as the stop loss, that is around here, and target up to the resistance level, right? This is this is a strategy that works precisely well in giving out good quality trade signals like this. So I hope you are clear with the strategy. Let's see another video with a new concept. Thank you. Hello everyone. In this video, we're going to discuss about a strategy that gives out a fine quality trading signal, right? So for that, first of all, I've taken three moving averages: 200 moving average and 50 moving average and 20 moving average, right? I've taken three moving averages, so I'm going to confirm the trend by using these three moving averages, which is, if this 20 moving averages is above the other two moving averages, then it is considered as an uptrend. And this 20 moving average is below the other two moving averages, then it is considered downtrend. Here you can see the 20 moving averages is above the other two moving averages, so it is considered an uptrend. So I have confirmed the trend now that it is an uptrend. So for further confirmation, I need to check with the price movement. So I'll use the trend line for that, where I can uh, from this low to this high and then to this low and then a high and then low and then high. So after the crossover has happened, the price movements also broke the previous high here. As you can see, the previous high has been broken here. So the price movements are also in uptrend, confirming the trend with the double confirmation using trend line and moving averages. So my decision now is to buy. So I should look for the entry here as well. Here itself, you can see there is a shooting star formation, candle formation around here and all. So after this trend identification itself, the formation of shooting stars or paper umbrella are frequent. So where we should take the entry is After the retracement, see here it the moving average line has crossed over, and the price movements broke the previous high, and after it broke the previous high it retraced again, right? So here at the retracement, when it broke the this level high, there is a pattern formation also here, shooting star. So here we can take the buy entry, right? Here we can take the buy entry, and if you do so, let's see the result. Now if you take, as you can see, take an entry here, and the price has moved far above, right? We have taken entry here and the price has moved far above, as you will be probably booking around here the target. So where you can keep the stop loss here is at the previous low. So the trend, when it breaks the previous low, then the trend reversal will happen. So here the previous low here is, as you can see, we can taken the entry around here. So the previous low is here. If the price breaks the previous low, then we exit the trade. So we keep the stop loss at the previous low here. So with this we take up the trade for the uptrend using these indicators. So this is how we can set up the trade with the double triple confirmations using moving averages and trend line identifications and candle formations. With triple confirmation, when the trade is set up, it is more likely to go for a high profit. So this is how we can set up the trade for buy trend. So let's look at the same strategy for the downtrend also. So here you can see that the 20 moving averages has gone down below the other two moving averages. So we confirm this as a downtrend. For further confirmation, we use the trend line for the price movements, where you can see from this high to this low and then to a certain high, and then after the crossover has happened, the price moved further down, right, breaking the previous low here. So after the crossover has happened, the price movement gone further down, breaking the previous low. So the price movements also confirm that this is a downtrend. So at the downtrend, we prefer to sell. So where to take the sell entry is now we should look for. So after the previous low has been broken, the candle itself gives you a confirmation that this is a paper umbrella candle formation. So here with this pattern, you can go for the sell trade, confirming with this candle pattern, or you can also wait for the retracement level here, right? After the price low has been broken, it retraces to some extent and then goes further down, right? You can wait for the retracement and you can enter the trade after the retracement. After the retracement, when the this low has been broken, you can enter the trade here. Either you can enter the trade after the previous low has been broken with the candle confirmation here, that is paper umbrella, or you can wait for the retracement, and after the retracement the price goes further low, breaking the previous low here, and after breaks this low you can enter the trade, and you can see the price movements going far below, right? So stop loss here is keep the previous high as a stop loss, that is up to this level. The trend prevails downtrend until this previous high has been broken, that is after the moving average crossover, the price movements from this high gone to this low, breaking the previous low. So this high stays as the resistant point for the downtrend. When the price breaks this downtrend, then it is considered to be uptrend. Until and otherwise, this is a downtrend. So we can take the entry, as I said, with the candle confirmation here or after the retracement level breaking the previous low, you can enter the trade as a sell trade and you can see the profit here. Keep the stop loss as the previous low, previous high, sorry, previous high, that is around here at this resistance level. You can keep the stop loss. So with this, I hope you are clear about this strategy, and let's see in another video with a new concept. Thank you. Hello everyone. In this video we're going to discuss about a price action strategy with which we can identify even the trend reversal in itself. So in the live market we're going to discuss it with the strategy. So here what I have done is I've added an RSI, relative strength index, to predict the price moments in the upcoming future. So with this, if I can identify the divergence between the price movements and this or a relative strength index meter, so then I can predict the trend reversal. So for sake here itself, we can find that, see, the price movements in the market are from this low to this high, whereas in the same here the price movements are from this high to this low. So you can see the divergence, that the price movements are going high and this RSI is going down. So there is a divergence happening between these two. So we'll go with the RSI where it goes down. So I predict the price movements also to go down from here. So let's see what happens further. Now as the price fluctuates between the range bound here, we'll also do one thing. We'll also add the trend, right, how the price movements are. We'll also add the trend and extend the trend line. So the trend line is like this. So we'll wait for what happens now. The market, yes, here you can see the trend has been broken down after the divergence has happened, right? Here the trend has been broken down. So we have predicted that the trend will broke down as per the RSI's indication. So here when should we take the trade is after the trend has been broken down, when the previous low is also broken down to creating a new lower low, we can take a trade, right? Here you can see the previous low has been broken around here. The previous low even has been broken. So with the candle confirmation forming the bearish candle here, we can enter the trade around here. So we can see what happens next if we enter the trade on here. See, the price movements are far down. So if we enter the trade here, you can see the price movements going far below. So regarding the stop loss, where you should keep the stop loss is the previous high. Where is the previous high? See, we can keep it around here where the previous highs are. So with this, we can keep the previous high where the resistance zones prevails for this downtrend. When the price movements break this previous high, then it is considered to be an uptrend. Until then it is a downtrend. So we have predicted it before the trend happens using these indication. So this is one of the price action strategy that we can have faith in. So if we enter the trade here with keeping the stop loss around here, you can see the price movements going far down, getting a huge sum of profit. So with this, I hope you understand how this price action strategy works to identify the trend reversal pattern and set up the trade accordingly. So also regarding the target, where you can keep the target is when it broke the previous low, you enter the trade here. You can keep the stop loss at the previous high. For the target, for sake, you can keep the previous low as the target. where you can see exactly the price also coincides with the previous low. So when I enter the trade here, I keep this up to, I expect market to go low up to this low, because previously it has been uh, touched until this low. So I'll keep this low as the target. So with this, I hope you understand how this price action strategy works. Let's see in another video with a new concept. Thank you. Hello everyone. In this video, we're going to see what are all the tools available in the trading view, and how to use it, right? So first of all, here it is a symbol search where you can search any symbols you want, any pairs you want, like euro, USD. And if you search it and you click any exchanges pair like owned or FXEM, let me click FXEM. So the chart displays then euro USD. Likewise, you can change whatever pair you want here, and next to it is the comparing symbol where you can compare one currency with another. So for example, if I choose GBP USD over euro USD, then the chart will appear like this, where red color lines are GBP USD, and the candles are euro USD. Likewise, you can compare between the two currencies. And then next to it is the time frame, where you can select the time frame for a candle, whether it could be 1 hour, 2 hour, 3 hour, 4 hour, 1 day, or whatever you want. Like even minutes candle is available. If you select 1 minute, so all the candles will be appearing in a minute basis, right? So likewise, if you select a time frame of 1 day, so every candle represents 1 day movements, 1 day price movements, right? So likewise, you can use time frame for your trade, that is around here. And next to it is the candles, I mean graph type, whether you can have it in bars or candles or hollow candles or line, whatever you want. For example, if you click a line here, the chart will then appear uh, as a line graph. So we generally prefer to have it as a candles, as majority of them use it like this one. And yes, so next to it is the indicators, where you can search every indicators you want to strategize your trade, like well, RSI. If I type RSI here and I click this, then straight away the RSI appears in the chart, so like this. So likewise, indicators, you can also add CPR. So CPR will be available with pivot levels, or you can even type MA for moving average, like updated use. If you click the moving average, then the chart appears with the moving average line. And here is the taskbar for the moving average, where you can change those settings for the indicator moving average. So length, if you want to give something like 50, so you will give 50 days length. And source, whether you want it close or close price or low price or high or open, whatever. So I prefer to close, so I'll keep it. And if you give OK, then the line will appear as 50 days moving average, right? So likewise, you can use the indicator, and you can also use the settings of those particular indicators. And then there is an indicator template, right, where if you click this, you can add some of those indicators of your own strategy, and keep it as a template, where you can, if you just click those template, it will straight away appear in the chart. So you need not to put it again and again as a strategy. You can just save your strategy. That is what template is all about. So we'll just close it. So yes, next to it is the alert. So alert is the symbol where you can use it only when you have the paid version, right? Even for free versions, I think there will be 2 or 3 alerts is permitted. And if you are using a paid version, you can use number of alerts you want. So for alerts, you can just enter the expiration time and all, and value where you want to alert yourself to take a trade. So if you keep a certain range where the price when moves you can start up a trade, you can keep that as an alert, and when the price touches that range, it will give you a alert, so you can start a trade. And then that's what alert is all about. And if you're having a paid version, you can use the number of alerts whatever you want. And if you are using a free version, and only 2 or 3 alerts are permitted, I think so. So then next to it is the replay option. When if you click it, the line vertical line appears, and if you click around anywhere like this, and then the chart moves appears, which means the when you click it, the candle will appear only before the line. So for to know what happens next, you need to play this option where the candles will appear, which means you can use the replay option to backtest your strategy or backtest any price movements you want. So you just click the replay option, and you just click with the candle, where from then you want to know what happened. So if you just click then, and if you click play, you can be able to know the candle movements after that. So that is what replay option is all about. And then here it is the layout option, where you can select how the chart should appear as a layout. So just for aesthetic purposes, these things are available here. And also here you can save all those charts and symbols on your own layout. So that is what this option is for. And then settings is what the chart properties, all those aesthetic purposes for the chart, where you can select the color for the candles, and where you can change the properties of the status line, so and all, which is all aesthetic purposes, nothing much important here. So let's move on to next, which is it is a full screen mode. And then this one, if you click it, you can save any chart image here. If you are putting a strategy around here, and if you want to save it, you can save it here. And you can also copy the chart image and send it to others like this. So you can share those images using taking the screenshot of whatever you've done on the chart, right? So that's for this option is for. And then moving on to next, which is on the left side, though, where all the tools are available here. We'll go to discuss one by one. So at first, this is the cursor symbol here. I mean, when you click this cross, so the on the chart your cursor appears like a cross symbol, and when you choose dot, it appears in a dot symbol like this. So that's what this option is all about. And moving to next, which is lines. So if you click this, you see the trend line and arrow and ray and info line and all. And if you click a trend line, you can keep on drawing like this, right? And if you click an arrow, you can keep on drawing like this arrow, and then like this, right? So S. So and then, so that's what this all lines are about. Horizontal line, if you keep this, the horizontal line places, and vertical line, if you keep this, the vertical line gets placed. So like what that, like this, all these lines are in this row. And then moving on to next, which is Fibonacci retracements. So for Fibonacci retracement, you can see there is a Fibonacci retracement, the first option you see here. And then if you click it, you can use the Fibonacci, where you can place it from high to low, and then drag it till the place you want. So Fibonacci places here. So for that tool, the option is available here for Fibonacci retracements and Fibonacci extensions and all the available options regarding the Fibonacci's are available here. So you can use this for your strategy. And then moving on to next, which is the shapes tool, brush highlighter, where you can click and highlight, right? You can highlight like this, and where you can brush like this, and all the shapes are available here. Rectangle, like when you want to create any zones around here, or rectangle, circle, ellipse, like that, all are available here like this, right? So all the shapes are available here, so you can use it to highlight or to mark up particular places, right? And then next, which is, so before that I'll teach you one more thing, which is the delete option, the final option. So I need to teach you at this time itself, because I just wanted to delete all those things here. So if you click delete, you can see the arrow here, and there are three options available here, that which is remove drawings. When you click remove drawings, all the drawings alone will be removed, and when you click remove indicators, and all the indicators will be alone removed. And when you click it remove drawings and indicators, every drawings and every indicators will be removed simultaneously, I mean together. And if you barely click this delete option also, everything will be removed on the chart, and the chart will be looking fresh with candles, right? Yes. So I did this because I need to clean up this mess I've created before for to teach you, right? So I've cleaned it, and I've also taught you what this option is all about. And moving on to next, which is text option. Yes. So text option is like you just wanted to type something around, like here. If you click here, the text option will appear like this, where you can type whatever you want. And then if you click OK, the text will appear here, right? So it may be useful whenever you wanted to make remember yourself of something or like that. So text option is all about this one. And also here you can figure out how your text option should appear. For example, if you click the call out option also, if you click on this candle and then drag yourself, so you can type whatever text you want here and click enter. So the text will appear pointing out at a particular place where you have kept this. So likewise you can use the text option with various types of mode where you can keep the text. And then moving on to next, which is patterns. Maybe if you are following a pattern for your trade, you can use all those patterns that are available here. Cipher pattern, ABCD, triangle pattern, everything's head and shoulders. So you can just, if you are a pattern trader, you would have known what these patterns are. So you can just click it and use it on the chart, right? And if you are not a pattern trader, this option might not be useful to you, or might not be familiar with you, and that's not a problem at all, right? So this is for pattern traders, and all the patterns, all the sufficient patterns are available here, so you can use it directly on the chart, right? So next, which is this option is particularly for the risk reward determination. So if you are creating a long position, and if you just create it around here, long position you create it, and you can keep the target wherever you want. Also you can keep the stop loss wherever you want, right? So I'll just remove this, because I'll just keep it somewhere else, around this option. So long option, or maybe short option could do better. Okay, so if I click short option, and all the target zone and the risk zone will be displayed, so you can keep wherever you want the target, right? So you can keep wherever you want to target, and you can also keep wherever you want to put the stop loss, and the risk to reward ratio will be displayed here. So we might have learned the 1:2 ratio could be good. So you can measure where you can keep the stop loss and where you can keep the target in order to get the enough risk reward ratio. That's what this option is all about. So yes, so in order to determine the risk reward positions, regarding that, this option is useful. And then this is the icon option where you can click it. This is icon option where you can click it and place it wherever you want, like, just for some purposes, maybe some humorous purposes, where you can keep whatever you want as an icon around here, just for a remembrance or something, not very important actually. So this is what this icon option is all about. And this one is a measure option. So in Forex, if you wanted to measure how many points are there from for a candle, for a particular candle, if I wanted to measure from here to here actually, so I can now know between these points, between these two candles, how many days it took, how many candles it took, and how many points and how many pips also is displayed. For 0.02346 points have gone down, and 234.6 pips has gone down. So you can measure using this tool for whatever the candle or whatever the range of price movements. So you can get to know how many pips are you're profiting or you're losing, right? So next one, which is a zoom in option, where you can click and you click it and you can zoom it like this, and you can click, if you click again the minus symbol, it will be zoomed out like this. So for zooming purposes, this candle is available, this option is available, so you can use accordingly if you want, right? And then the magnet symbol, if you click this magnet symbol, it always points out to the exact point where you should keep the cursor or line, like that. So if I wanted to do a line, so it just clicks to the point where the candle exactly gets closed, right? Even if, see, I started from this candle exactly and I have closed on this candle exactly. So for the exact point purposes, this magnet symbol is used, and if you use this symbol, the cursor will right away move to the exact precise point where the candles closed or opened. So you can, if you draw a line, horizontal line or vertical line, whatever, it starts and ends to a perfect candle's open or closed position, right? So that's what magnet option is all about, and I'll just take it out for a while. And this option, stay in drawing mode, if I check out this option, and if I click this trend line option, if I draw only one time, I can draw. For the next time, if I have to draw, I need to click it again and I have to draw this. So for this purpose, if I check in, click stay in drawing mode, then if I once click it, I can draw for as many times I want, right? For this purpose, stay in drawing mode is there. And this is a lock option, where you have drawn something, or you have put a strategized something on the chart, where you have to lock all those and it should not move anywhere. So for that purpose, you can use this lock option. And then this is the hide option, where you can use it to hide drawings or hide indicators. So if I click hide drawings, all drawings will be hidden. Likewise, if I click hide indicators, all indicators will be hidden. For that purpose, hide option is there. So and then finally coming to the last option, which I taught before, which is the delete option. I'll just click on it, on the dustbin symbol directly, and everything is deleted all at once, right? So if you wanted to delete it purposely, any drawings alone or indicators alone also, the options are available, right? So all those things are taught to you, which are all the important things. And here it is the price range, and here these are all some symbols that might be useful. Here it is a chat option, private chats, where you can chat with the peer groups, and you can stream your ideas here and here, and all the news are available here, and alerts option is also here present. And this is the watch list where you can add whatever the currency pairs that you are going to trade. You can add those in the watch list, so you can directly click see here itself. You need not to type every time, right? So you can just add it in the watch list. So I think I have taught you what are all the important things that are around here. So with this, I hope you are all clear about all the tools available in the trading view. Even paper trading option is available here. For that, if you click the trading panel, and paper trading option is just available here. And if you get connect, it gets connected, and all the trading will be done virtually, no money involved. So this option is also available here, and Pine editor here, where you can even create your own indicator, right? So for that, Pine editor is also here. So every options certainly is present here. So with this, I hope you're all clear about all the trading view tools and options. So yes, thank you.